you. Today is Tuesday, the 14th of July, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Now, yesterday we talked about scaling a company or the circumstances around scaling a company. So I think the basic point was quite simple. A company can get bigger and weaker at the same time. And you say how that happened. Well, yesterday we went through that. But today we move into the right hand of the model, and let me put it on the screen, which is predictability. Now, in the advisory board operating system, predictability encompass a few things that are very important, which is partnerships, revenues, and assets. And we are going to, or I'm going to put this about together today, how it works when you're growing a company, you're scaling your company. So here's where many founders led businesses get caught. They go looking for capital before they have built enough confidence for the capital to be attracted to that particular company. So they present the ambition before they present control. They ask lenders, investors, and shareholders to believe the future, while the present is still a bit fuzzy, if you may. So that gets expensive. And why? Because capital does not follow noise. Capital follows trust. They need to trust, and the predictability is portion of that. So let's take a look at three problems with this. Problem number one is that the market is selective. That means that weak capital stories gets punished quickly. If the business cannot explain revenue quality, cash timing, margin strength, and delivery capacity, it becomes harder to negotiate from strength. Problem number two is that access to money does not mean comfort. You might have a list of people that you know in terms of institutions or lenders or investors, but even when capital exists, the business still needs to answer better questions. So, for example, what is a plan? And you say, well, basic, but believe it or not, many times people come with good ideas, but not a business plan. Or what could go late, yeah? What things are delaying things actually are making a knock-on effect. What happens if sales take longer? What happens if hiring costs more than actually what is expected? What happens if cash collection slows, right? So many people look into these financial models, and what they see is a mathematical projection. They don't see any risk reduction or how it's called, fix. It's not a fix is the right word, but they don't preventions or ways to address those risks. So a board that cannot answer those questions is asking the market to take too much on trust, right? So, and problem number three is that the finance lenders remain cautious when operating story is weak. If a forecast depends on performing timing or perfect timing, perfect sales and perfect delivery, it's not a plan. You look at those kind of things and you say, well, this seems to be a bit artificial. I just in the soft side of the wording, because it really looks artificial. I say mathematical Excel sheets are very good, but in paper, then you have to hit the road and deliver that, and that's where the reality is start to be more different than actually the plan that you had, and then you see situations happen that are not the most comfortable or pleasant ones. So, in other words, it's a good wish. So the people sign off investment, or people that is signing off the investment, will feel the wobble, even if the slide deck looks very polished and well prepared. So, in other words, imagine the capital as oxygen on the mountain. You're right. So if you are climbing, if your lungs are weak, if you're not very well prepared, having more oxygen doesn't not make the climb easier, because actually your physical conditioning is not there, right? So even if you get more oxygen, more capital, your company is not prepared to stand that strenuous situation and demand from a higher altitude. So it shows how unprepared you are, unfortunately. Now, As a board advisor, what I would propose to consider is the following. First, stop treating forecasting as a theater. And yes, many, many times looks like a theater. That's why I employ this word. It's not because I want to be dramatic. It's like when sometimes you go into these meeting rooms and see these PowerPoints or the decks, you go like and say, well, but sorry, no. It's unfortunate that actually people go through this length of effort to and don't grasp these basic principles. So I'm here to give you the first thing to consider. Revenue should align with sales cycle reality. Margin should align with delivery reality. And cash should align with timing reality, right? If one larger customer sleeps by 1 quarter, the plan should still make sense. And this is one of the questions that you may have. So, which is the weight in terms of revenues or the quality of the revenue, something that we discussed last week. And many people are not prepared to answer that question. Even if they know it, they don't know how to articulate the answer correctly, even if they have the right data. So be prepared for questions that actually are coming from the investor side, not from your operation side. The operation side have the answer, but not always I can deliver the answer. If one project costs more to deliver, so you know the effect of that. So if how it's going to impact the organization if something is more costly than forecasted. If cash conversion slows, it means actually you might have the revenue booked, but the cash is not in bank. So the company should know how much room it has to operate when the cash is not in bank yet, even if the revenue is booked, the invoice over sent, but the money didn't hit the bank account yet. The second thing to consider is use the advisory board operating system asset lens for this stage. Predictability connects to partnership, revenue, and assets, as we see in the model here. So the partnership should make growth more dependable, not more confusing. Meaning, and we spoke about partnership yesterday also, the partnership is a way to distribute and leverage the efforts of many, many other organizations in the market to increase your revenue in a more stable way. And we brought the example of Sage, the company that actually is predicting, or their plan is to put 93% of their revenue through distribution, right? So the only 6 or 7% of their revenue is coming from their inside sales teams or their sales teams. In terms of revenue, should show repeatable demand, not heroic selling. And how many times you've seen these quarter ends or year ends that people goes like all hands on deck, sales bleeds, everybody on the phones, everybody on the road. And these are heroic efforts, and you have to do it every quarter again and every year end again, and everything is the same story, because actually you don't have, or probably you have the mechanisms, but actually they are badly deployed. So the revenues are quite unstable. So you have like you call it, a hockey stick, right? So it goes very flat and all of a sudden you have a pike, and then goes flat again, another pike. So that sometimes is very, very, not sometimes, many companies operate in that way. And it seems actually it's predictable, but it's also at the same time quite strained on everybody. So assets should include, in the third section, your assets should include your system, your contracts, your data, your customer quality and delivery engine, and what make revenue easier to trust. And the third thing to consider is show the board's logic in plain English, because many times the board advisors or the board of non-executive directors are quite cryptic in their message. So how you can show that in plain English, I have a few questions that I want to share with you. So questions that they should ask that make things to the more accessible language, put it that way. What has to go right? What might be late? What breaks first under pressure? What happens if growth is lower than planned? What happens if cost rises? Yes, what happens if the market takes longer to respond? And all these questions are very good because they start to give you an idea of what's going on. So investors do not need a fairy tale. They are also people that understand business. They need a management team that can see around the corners. And this is where the advisory boards helps. A good advisory board, which is not your executive board, not your C-suite, not your management team. A good advisory board is an independent body from the organization, brings a mix of business the mix that the business needs now. That might be a former CFO, it might be a pricing expert, it might be a commercial operator, it might be someone who has raised capital at the stage you are entering now. So not where you are now, but the next step that you're going to do. So they know more, or just a few steps ahead of you, but gives you the capacity to enter that stage with confidence, and also with the right connections and the right vocabulary and capacity to deliver at that level. It might be someone who can test whether the revenue model is repeatable or not. So the point is not to hire one person and hope they fix a cross-functional issue. And many people can find these people. They are very expensive, very rare, they exist, but actually you have a very long period until you find it, and somebody that you can feel happy with that. But the point is to bring the right judgment into a room at the right time. And this is a key point. So this right judgment can ask questions like, a growth story is strong, for example, but the operating proof is thin, right? So they can see these things very quickly. And they say, well, I thought about it, but I never put that in paper. My last question, like a forecast, is confident, but it's not stressed enough. And I would say, what's stressed enough? All these questions that we asked before. Also think that they might think look into capital ask is clear. So you go into investors, lenders, and they say, yeah, the capital ask is clear, but the risk story is not yet credible, meaning that you haven't addressed these amendments, or not amendments. I'm still looking for that word because it escaped me. Treatments for risk. That's the word I was looking for. So those levels matter because they stop the business confusing ambition with fundability, meaning acquiring funding for the business. So what do you gain working with me? Three things: business outcomes, differentiators, and risk reductions. In terms of outcomes, is a stronger predictability. The company becomes easier to fund because the board can explain how growth behaves, not just where growth might come from, right? How growth behaves. That's a very important distinction. The differentiator is a rotating international advisory board built around the growth and capital milestone of your organization. So it's built for purpose. You get specialist support on revenue quality, capital design, board reporting, and commercial discipline faster than hiring one executive, as mentioned, with a lower overhead than a big consulting firm and no talent locked in. And this is a very important thing because you don't want to lock into the capital raise expertise. Then you want to go into other stages of your organization. So we can rotate members where the need is in your organization for the next milestone. And the risk reduction is a weak capital timing. And this is a reduction, the risk that we're reducing. The business avoids asking for money before the operating story is strong enough to support better terms. Because when you can access capital, but the terms start to get very, very uncomfortable because you cannot support the operating story. So how you're going to operate it, how you're going to handle these things, how you're going to predict that, or it's not a prediction like an oracle. It's how predictable is the things, because actually you are joining certain points that say, oh, we are going to, it's very likely and very achievable to land in that place. So the capital have the return that they're looking for in terms of that investment. Now, one action you can take home today, and it's doable in 30 minutes or less, and let's put our visual aid on the screen. Here it is. Take your next 12-month plan and run a stress test. So what happens to cash, margins, and headroom if revenue lands 90 days late, right? So you have a little chart here, you can put that there, and what you get out of this. So if we have weak answers to all this grid, then the predictability is not strong enough yet. So you have there a very good idea where you need to put your effort to make sure that the predictability is a believable narrative when you're going or reaching out for capital with investors, lenders, or shareholders. Now, let's pause here for today and reconvene tomorrow, because tomorrow we move into the bottom of the model, which is your systems and controls, because predictable growth only stays investable if the machine underneath can make the strength, or can support the strength of going through that stages. Now, if you're a founder, a chair, non-executive director, any person in the C-suite of your organization, you need growth capital without giving away leverage through weak confidence. Let's have a 30-minute chat so I can understand where you're coming from, where you are today, where you want, what you want to achieve, so we can create an advisory board tailored to your needs, not for the fancy names of it, but actually something that delivers results to your organization. Have a great day, and I'll talk to you tomorrow. Thank you, and bye-bye.